Welcome to CrushTheStreet.com's weekly market wrap-up. Let's get started in the equity sector, which saw yet another session of positive gains, and for the Dow Jones Index in particular, this makes it 10 in a row, a record not seen since 1996. Not to be completely outdone, the S&P 500 is closing in on its all-time high. Much of the enthusiasm was sustained by favorable jobs data, which indicated that the number of new claims for unemployment insurance declined for the third straight week. I think this is a great time to get into the markets. Most of the major indexes are either at or above record-breaking levels. Regular folks are getting aroused with the aroma of yet another financial opportunity, and we all know that CNBC never gives bad advice. So really, what could go wrong? Of course, I'm being facetious. There's a lot that could go wrong, and if you buy on margin, the wrong would get wronger. In times when everybody else is focused on the latest tech stock, it's important to consider ignored and therefore undervalued sectors. If anything, if the entire markets collapse, undervalued stocks theoretically wouldn't have that much further to drop, as most of the shareholders have already dumped out. But with so much bullish enthusiasm built into the latest rally, where can a shrewd investor find an undervalued sector within the US equities market? The answer? Education. Let's consider the technical charts for American Public Education Incorporated, which is a provider of online university courses. From August 2010 until March 2012, APEI traded in conjunction with the S&P 500 index. However, from the first week of March until May, APEI gave up nearly 40% in valuation, while the S&P only declined by a little over 8%. Since then, the correlation ended, and while the S&P is near its all-time high, APEI is near 3-year lows. The interesting thing is that APEI is not the only education stock that exhibits these technical patterns. Take a look at Education Management Corporation, or EDMC. Since March of 2012, its direct correlation with the S&P 500 evaporated, losing 77% in share valuation. Or consider Career Education Corporation, ticker symbol CECO. It also lost correlation in March of 2012 and dropped nearly 80%. It's the same story with Lincoln Educational Services, although share performance for this company is doing a better job of recovery than the other companies mentioned. Why should investors consider the education sector? For one, tuition and other expenses have been soaring compared to the average income of American families, and this situation may not reverse for quite some time. Second, the government has a vested interest in keeping education costs high, as it forces declining middle-class families to encourage their children to consider joining the military as an affordable solution for rising college tuitions. While this may sound conspiratorial, consider the fact that the government is one of America's biggest employers, and churning out subservient minions to do its bidding is only a positive for them. And while we may never win a battle against big government, we can most certainly profit from it. And that will do it for this edition. Thanks for watching, and we'll see you next week.
For more unconventional ideas, please visit CrushTheStreet.com.